In 2019, stablecoins were a niche $5 billion tool for cryptocurrency exchanges. Today, they constitute a massive $300 billion cross-border finance mechanism. The theoretical literature exploring how these digital assets interact with the broader economy is extensive, yet proving their actual causal impact on traditional financial markets has remained elusive. The core obstacle is endogeneity. Cryptocurrency prices and macroeconomic variables continuously co-move. When traditional markets shift, crypto reacts, making it exceptionally difficult to isolate a pure demand shock originating exclusively from the stablecoin ecosystem. A recent IMF working paper titled Stablecoin Shocks provides a methodological breakthrough to solve this exact measurement problem. If economists can successfully separate pure stablecoin demand from ambient market noise, they can map exactly where decentralized capital bleeds into the real economy. Standard high-frequency identification models usually rely on rapid asset price adjustments. That fails here because stablecoins are pegged to a fiat currency. Because the price remains static, fluctuations in demand only materialize as adjustments in market capitalization, specifically the minting and burning of the tokens. To capture this, the researchers constructed a novel dataset. They isolated 50 stablecoin-specific news events, like the drafting of the Genius Act or Europe's MiCA regulation, and tracked the high-frequency daily changes in combined market capitalization on those specific dates. This chart shows heteroscedasticity-based identification. By proving variance in market capitalization is significantly higher on event days compared to randomly selected control days, the researchers can mathematically isolate the true stablecoin shock from background noise. This shift in variance allows them to instrument a structural vector autoregression, or SVAR. An SVAR is a statistical model used to capture the linear interdependencies among multiple time series without relying on strict short-run zero restrictions. We validate this instrument with the first stage F statistic. At 12.78, it sits well above the conventional threshold of 10, confirming a robust signal. By mathematically filtering out the broader market noise, this methodology yields a precise lens to track how crypto demand alters the plumbing of traditional asset classes. The most critical transmission channel identified by the model lies squarely within the U.S. sovereign debt market. This chart shows the impulse response function for the 1-month Treasury yield, tracing a system's reaction to an external shock. Here, a 1% increase in stablecoin market cap causes a persistent decline of 1.9 basis points in short-term yields. The physical market plumbing drives this drop. Stablecoin issuers are legally and structurally required to back fiat inflows with highly liquid, short-duration assets. When a user deposits dollars, it triggers an automated purchase of Treasury bills maturing in under 90 days. Looking at the reserves for major issuers like USDC and USDT, between 35 and 62% of their entire holdings consist strictly of these short-term U.S. Treasury bills. However, this impact decays as duration increases. When applying the exact same model to the 10-year Treasury yield, the data shows no statistically significant effect. Systemic stablecoin demand forces persistent buying pressure at the short end of the yield curve. This dynamic directly lowers U.S. government borrowing costs. This yield compression in domestic debt creates an immediate secondary effect in global foreign exchange markets. The theoretical assumption among many observers is that massive foreign demand for USD-pegged stablecoins should inherently strengthen the value of the U.S. dollar. This chart shows the impulse response function for the broad dollar index. The empirical outcome contradicts the theory. The index actually depreciates by 0.09% at the trough. The dominant macroeconomic mechanism at play is global portfolio rebalancing. Because stablecoin demand compresses short-term U.S. yields, these assets become less attractive, prompting capital to rotate away to higher-yielding jurisdictions. This capital flight driven by lower rates simply outweighs the direct foreign demand for the digital currency itself. The data confirms that stablecoins' impact on the global dollar is dictated primarily by traditional interest rate differentials. Macroeconomic gravity still applies to decentralized assets. Transitioning to the firm level, we can examine the ultimate regulatory fear surrounding this technology, the threat that stablecoins will trigger slow bank runs and disintermediate the banking sector by siphoning away deposits. The central question is whether institutional equity markets actually price in this existential risk to banks when stablecoin demand spikes. This chart displays the event study equity responses for major financial firms. Payment infrastructure providers capture statistically significant gains. Coinbase equity rises by 1.4%, while PayPal increases by 0.5% on a standard shock. Contrast those payment rails with the banking sector data. Large multinational banks, small banks, and community bank indexes exhibit virtually zero reaction. The stark divergence in p-values, the statistical metric used to validate if a hypothesis is true, proves that the market completely ignores the deposit flight narrative. Despite intense regulatory anxiety, capital markets currently view stablecoins strictly as a windfall for existing digital payment networks. They completely fade the idea that these tokens pose an existential threat to traditional lending institutions. A lingering econometric skepticism remains. Is this market behavior just an artifact of the specific narrative events chosen for the study? To address this, the researchers deployed a final robustness check known as the max share approach. This method identifies economic shocks strictly by maximizing forecast error variance, removing narrative human judgment from the equation entirely. This chart shows the original impulse response curves overlaid with the max share outputs. The curves align nearly perfectly in both shape and magnitude across all variables. This unshakable mathematical reality has direct implications for the incoming wave of global policy, such as the U.S. Genius Act and Europe's MiCA framework. These new regulations explicitly mandate that all authorized stablecoins hold highly liquid, short-duration assets. Regulation isn't taming the stablecoin-to-Treasury pipeline. By legally mandating T-bill reserves, governments are permanently institutionalizing it. Exogenous stablecoin demand is no longer an isolated crypto ecosystem phenomenon. Tracking stablecoin minting velocity is now a strict prerequisite for forecasting front-end yield curve dynamics. This transmission is entirely dictated by the mechanical realities of reserve asset composition. As the $300 billion digital asset space matures, the border between decentralized finance and traditional sovereign market plumbing has officially been erased.